What is up, my dudes? Today, let's talk about equilibrium. Today, unfortunately, I don't have a webcam, so you can't see my wonderful face, but I'll have one set up in the next video. But let's get on with equilibrium. Let's say we have some sort of uptrend here. Equilibrium is just the middle point from the high to the low. From the high to the low, and then a higher time frame equilibrium could be something like this, and it could help us catch higher time frame retraces for even higher time frame bullish moves. So let's say price runs up and makes a new high. Cool. So what I'm thinking is, all right, if this trend is actually strong, where would price realistically want to pull back before continuing? So equilibrium is just like the lows that I was talking about earlier. It's just like liquidity sweeps. It's just another reason for price to continue going into the direction it originally wants to go. And so if we look at this, let's say we're trying to catch longs, right? Let's say there's this uptrend and we're trying to catch longs. We're trying to catch longs ideally at a point that's not too expensive for us to catch longs, but at a point that also confirms that we still want to go higher. So you do this by trying to find the equilibrium, the middle point before the low and the high. And when price retraces into that, maybe it finds some kind of other area, previous highs, order block, etc. It finds some orders that it could fill there and then push price higher. So what even is equilibrium? Equilibrium is just the 50 point. It's just this 50-50 point. What does smart money want to do? Let's say smart money has this sort of stock in mind, or this index, or this pair, or whatever. And this index makes a new high. Smart money doesn't want to buy up here because the area above this 0.5, that's a premium. The area below this is a discount. So smart money wants to buy here at the discount because they can buy things at a lower price. So what are they going to want to do? They're going to want to wait for price to develop into the zone, or they're going to want to push price into the zone, fill their orders, get a liquidity sweep in, align it with previous all-time highs, get the orders that they need, buy it at this discount area, and then send price going higher. So instead of buying at the top of moves, they're able to buy more near the bottom of moves. And you'll notice that the market does this constantly. It pushes up, then retraces, then pushes up again. If we go on the daily here, let's find an example. Here's one. So we have this big uptrend that's going up. We have up move, down move, up move, down move, up move. This is a monthly uptrend, and this happened from 2024 to 2025. I assume this is when tariff news was announced, right? And so what does price do? Right here, price has this uptrend created. And what does price do? Price dips into the equilibrium of this uptrend, sweeps out this low, fills in some orders, even hits these previous all-time highs just barely, which could count into tapping this ginormous order block. And it ends up pushing and going higher. Now, as an investor, you're not looking to take the intraday trade. You're not looking to go down on the 4 hour or the 1 hour and scale down and try to find a certain break of structure or whatever that you could take to the upside. As an investor, what you're trying to do is just find an area where you can invest with the highest probability that it'll go up. And by using equilibrium, you can find that area. Like in this example, if you used equilibrium, it's actually a little lower, from this low to this high, price was developing and you're like, okay, I want a new investment opportunity. You could look at this and see equilibrium aligns with the weekly low, but there's also a low here, and there are all-time highs here. So what you could do is you could either invest at each of these points individually, or if you want to be a safer investor, you could have waited for the last point to get hit, because if the last point got hit, that means each point below that or above that got hit. And so what you would see happen is that price eventually dipped down into this equilibrium zone, into this low, and then at the previous all-time high. And what did price do? If you bought at the previous all-time high, you would have caught the very bottom of this up move, more than 27%, and still climbing because obviously this is where it's at right now. So you would have been up more than 60%, which is insane for an index. But as investors, we're just trying to find the safest way to invest, but the best way to also multiply our gains, because not only would this be less safe because if you invested just at the equilibrium point, you'd have been down 5%, but you also would have only been up 48. Whereas if you took all these things into account, the levels of lows I've taught you in the previous video, and if you're going to take a look at these all-time highs in this whole order block zone, which I'm going to teach you in the next video, you would have been able to catch this gigantic up move of nearly 60%. It happens all the time. So if we go on the monthly, we can even see that right here. When was this? 2010. This was way back in the day. Would have been right here. Price started falling in 2011. You'd been like, okay, this might be an opportunity for me to catch a trade. And so what you do, you draw out your equilibrium. You take it from the lows, the previous swing lows, to the previous highs. and then you mark out your levels. Okay, there's a monthly low here, but it's really close to the highs, so you probably don't want to use that one. There's previous all-time highs here, and in general, just this entire order block zone. It's previous all-time highs here, but that's above equilibrium, so you don't want to be buying above equilibrium really. But then there's this order block zone where there's just a couple of monthly lows stacked together from here to here, where orders were filled. Maybe you scale down to the weekly to find some liquidity sweep lows, and you see, okay, perfect. There's this low. That looks pretty nice. And so what you do, you wait for price to hit these lows. And you see, wow, price did that really rapidly. But we see that price hit this all-time high, but you don't really want to buy there because that's only one level. Then price hit equilibrium and you could be more inclined. But then price hit this weekly low. And already you could see that from this weekly low, it had a little bit of rejection, which means that even though it ended up going down, there was obviously support at that low, which means that if you bought it, that's a good thing. But then we see that price keeps dipping down. And where do we have our other buy point? Well, if you can actually see, there's another low here and it's paired up perfectly with this order block where orders were filled. What happened? Price went down. Yes, you might have been in some drawdown, but overall orders were filled and you would have had maybe an average entry around here and price eventually. So what ended up happening is that you would probably have an order around here as an average entry price, and price eventually started going up. The whole point is that it's not that price is going to immediately reverse after touching each of these levels. That sometimes happens, like in the example we just showed. But the point is you want to buy at these levels because a lot of people are buying here. A lot of people are at these highs buying, and then they see their index going down 18% in a matter of a couple weeks, half a year. They see an index going down 20%. But you want to be a smart investor because you want to buy more when it's lower, so that when it goes higher, you make more while they're sitting at barely a 2% gain. And so the point is, you just want to be not necessarily on the bottom of these down moves, but you want to find a better opportunity to invest, such as this equilibrium point. And pair this with other levels, such as the lows that I taught you and the all-time highs and order blocks I'll teach you in the next videos. And you could be a pretty lethal investor. Let's go into gold. So say right here, we have, this is a good example. It's an alright example. Right here, we have a pretty prominent low. I think this might be a low on the 3-month actually. That's how prominent it is. Is it? Yeah. So there, we have this low. Okay, well, this low is also low on the 3-month, but this is the prominent low that we're looking at. It is a very prominent low because, as you can see, there's started a little bit of consolidation. Each of these candles is 3 months. So just imagine 4 candles is a year. So for a year, it held tight in this consolidation range. So what you do, you draw your equilibrium from the low. And remember, a low is a down candle and an up candle. So you draw your equilibrium from the low to this high. And you see that we had this consolidation. Price broke through it. Price tapped into equilibrium and then eventually started going back up. So equilibrium was used as a way to buy gold at a discounted price to then go up, obviously more than 100%. And then, not saying you did hold, but theoretically, if you did, you'd be up 265% on a gold investment. But if we scale down even further, we could see that we had a low right here. We could see that there's previous all-time highs right here. And we could see that this entire area is like an order block. And price perfectly filled in. So we have monthly lows that price swept. We have all-time highs, and we have equilibrium and an order block all aligning together. You can pretty much safely admit that this is a really good price range to be buying. And another thing to note, if there's just monthly lows in equilibrium, if you want to be a very long-term investor, you could just buy at this. But if you see that there's just a price range where all levels are adding up, if you really want to get to the bottom of moves, maybe just wait until all those things are hit, because that way you'll have the most certainty that price will go up. Because if you bought at this order block range, you'd have literally been at the bottom of the down move and you would have been able to capitalize on all that gain. And I'm going on gold because I'm showing that even on things like gold, you would have thought maybe this is only applicable to stocks, indexes, Bitcoin. It's applicable to gold. So if you want to be a really safe investor and just kind of hedge against inflation, you can even invest properly as a hedge against inflation. We can see that here there's a little pause. There's a little pause area. So this had a little consolidation block and then price broke through out of it, and so we can use that as our equilibrium point. And I'll get into more of it later, but you don't necessarily want to be using just consolidation blocks, equilibrium points. For things as safe as gold and as safe as indexes, you can use this. But if you were to look at a stock like Tesla, which is a little more volatile, you'd probably want to go here, and because a lot of the times Tesla might go into a short time frame equilibrium but then just keep falling. And so if you really want to be safe, You want to go for like, okay, what looks like the absolute bottom of this entire up move? It looks like this. With things as safe as gold, you could probably drag it a bit here, and then you could see that price entered equilibrium and then ended up going up, consolidated a little, but eventually it ended up going even higher. If you go to a stock like Dell, you could see that there's potentially a lot of opportunity here. I was like, if you went and did bar blade here. So Dell has existed for a long time, but this stock's data is only available since January 19th. So you could trust it as a stock. It just only has its data since 2019. So this isn't like a penny stock. Like, we know Dell. Dell has been here for a while. And so gaps are another thing that I'll talk about in a future video. I might combine it with order blocks and stuff. Order blocks and gaps, I'll talk about that. With everything, high time frame holds higher power. So of course, if you draw an equilibrium from this point to this point, it's going to hold less power than all-time equilibrium, like all-time lows to all-time highs. But I was looking at this portion, you would have seen here that there is a large up move, and then Dell is starting to fall. And let's say you didn't get in it on this investment. Let's say you missed out on this. So you'd have seen this, and you would have thought, okay, say this is the high. I want to look at equilibrium. And look at this. The high perfectly aligns with the monthly low and equilibrium. And we're already in this kind of order zone. And so if you were to scale down on the time frame, you're seeing that, okay, we swept out this low. We kind of hit this block. This could have been your buying opportunity. So you could have bought when price reached this low. And again, as you could see, price clearly already had a reaction off of it. So this is a good place to buy. Price already reacted 15%. Let's say we're not going to take any profit because we want to hold it forever, right? If we would have waited, it would have gone back down eventually, but we maybe could have found another opportunity here off of another weekly sweep like this one. And then what happened? Dell eventually skyrocketed up. So what did smart money do? They waited for price. Everyone was losing money and then selling because they're scared. Smart money used that fear and momentum to push price into a discounted range to then buy up their orders and then launch it. You think it's a coincidence that so many stocks have just boomed like this? Like, does this look like normal stock action? Like, if you bought it here at the peak, you would have made 3 times your money, which is absolutely insane. This isn't like years ago. This is literally February of 2026. Investing solely, equilibrium is a very good point to combine with other highs and lows in the market or with other levels to then invest. Because even if you bought it only off of equilibrium, like the only thing you paid attention to, and you just bought when it crossed the line, you'd have been down 5%, but then you would have been up 300%. And so as you can see, it's a really good level to buy off of. Let me get another example. Netflix. I think I was trying to show this one before. So Netflix, we have this super crazy crash that occurred right here. Super crazy crash, and we have this low. And this is a super insane like because it caused, or it was right after this crash. This is the low of this crash. This was all data, all fear, all news. That Netflix slowly started to go up. And so if you combine Netflix's low with its high, like this is a super imbalanced price range that price might just really want to get the discount of. And as you could see, if you would have marked out from the low to the high, price just barely dipped underneath it. And so what you could have done is you could have bought there. And then what did Netflix do? Netflix had a rejection of 44%. But personally, I'm looking for these all-time highs to get hit. And if that happens, I'm going to invest a lot into it. And you might be thinking, why? Well, if you drag this equilibrium point to absolute all-time lows, you could see that Netflix's all-time equilibrium aligns really well with the previous all-time highs. So if Netflix goes on and drops to this level, 67.14, this is a very good buying opportunity because not only are we at all-time equilibrium, which is insane for a stock, so it's at a 50% drop from the previous high. We also met up with previous highs, and I'm sure on the weekly, there's some order block, or on the daily, there's something we could do to take trades. Oh, a daily gap here, which again, like I said, I'll talk about gaps in investing in a future video. But there's a gap here, which clearly can give us an entry. And this could be a very good buying opportunity for the future. We could even use this in crypto. So let's see. We had this low and this high. Bitcoin dropped into this equilibrium point, aligns perfectly with, I already spoke on this in a previous video, but it aligned perfectly with previous all-time highs. This little consolidation block, this little order block in the middle of it. And if you would have bought in that price range, because you had so many things coming together, you had this order block, equilibrium, previous all-time highs. Although Bitcoin has faced down move now, if you would have bought at around this area, you'd have been at a 30% gain on Bitcoin. So a lot of people were buying at 120K, 110K. I'm sure if you check Reddit, you could find someone who bought at the legit top. So all these people were buying at the top while you could have been buying at the bottom. And like I said, the long-term structure, maybe Bitcoin keeps going down. But the point is, you bought at a point of reversal. These guys, they just bought it when there was a falling knife. It was a falling knife, falling knife. You bought it, it was still falling. But after you bought it, it started going up because you combined all of these levels together. Like I said, these things are just to find like the bounces. It doesn't necessarily suggest that it's going to keep on going forward, because if the market sentiment is that Bitcoin wants to go down, I mean, who's going to stop Bitcoin from going down? But these places are just to find the little places where Bitcoin can bounce, and if it chooses to, can continue to go higher. But obviously, what can Bitcoin do? It can use this, fill in some imbalances right here, and then go down lower. A lot of super big name stocks, you can't really equilibrium off of them. So it's the 22nd year of 2000. I don't know why I said it like that. We had this low right here, which was a very solid low. As you can see, we have this consolidation block, which I'll teach in another video. And if you would have bought here, combining all these three, if you would have bought here because you want to be super safe, you're in the most amount of profit, but you could have bought some here and have like a rich buy down here. That's still nice. Or if you were scared that this was a 66% fall and that this was a crazy fall, you could have maybe drawn it at all-time equilibrium, because like I said, the higher time frame holds higher power. So all this would do is just make your buying a little to the downside, but it wouldn't change too much. But again, you would have bought some here. And the whole point of this is that if you invest at equilibrium and then combine it with other levels, the whole point of this is just to dollar cost average enough so that your entry is in the discount range when price starts going up. Because you don't want to be in the premium when price starts going up, because not only will you have less profit, but if price decides to reverse down when other people are just entering, you're at a minus 50%. So someone here saw this bounce, I don't know, saw supply and demand resistance, some random thing. He bought in here, then he was down 55% when people like you could have been literally just investing. And by the time he got to his break even, you would have already been up 150%. So the whole point is just to dilute down your buy-in so that by the point it goes up, you're in a discounted price range and you don't have to worry about that much. So the whole point of equilibrium is just trying to figure out where price is likely to go. If you're at the highs, you might be thinking, okay, price looks overextended. Like if you look at AMD, price looks super overextended. Like you think that in 10 years or in a year or whatever, you're going to be looking at the chart and it's going to be over here and not have filled any of this. If it's going to be over here, it's most likely going to have filled all this price action. I mean, if you look at all of the times that AMD just had a super massive pump, it's been able to fill it. We had a pump here, we filled the price action. Had a pump here, fill the price action. We're probably going to fill the price action. How do you know where price is going to go? Price is likely going to go to the equilibrium of this price action. Here we had a super large high. What happened? We filled in the price action. So equilibrium is just made for you to kind of know where price is going to go. And so the next video, I'm going to be talking about how to kind of pair equilibrium. There's no real specific formula for pairing lows, equilibrium, and all the sorts. It's just that the more things you have combined together, the more you could do. Like he had this gap combined with a low, and it was just a very solid opportunity to buy AMD, which is, if you see this, this is the weekly low that I marked out. This is the gap. If you would have bought at the sweep of this weekly low, you'd have been on the upside of this entire move. And so in the next video, I'm going to be talking about, or in the next videos, I'm going to be talking about gaps and like how to use them, how to identify them, and what to even do with the gaps. All that's left is going to be a video for putting it all together, and then perhaps talking about take profits. And there's not really stop losses if you're dollar cost averaging, but I guess when to know to stop dollar cost averaging is a good video, or it would be a good skill to have. And also, I guess, more focus on what stocks to look for. And comment down below if you'd like to see like some more specifications about equilibrium. And constantly say that, oh, there's a low and there's a high, equilibrium, buy. Sometimes you just can't buy at equilibrium, and you instead want to kind of wait for a strong equilibrium. Like you just don't want to buy at the equilibrium from here to here, because as you can see, it was a low and a high. It was technically an equilibrium, but price completely just negated it. And if you want to know like when to kind of spot it as equilibrium and when to kind of spot it as a monthly low, if you want to kind of a more in-depth explanation, comment down below. But honestly, I think that even just this explanation, this will put you so far ahead of the rest of the people. And if you made it this far into the video, thank you, and I'll see you in the next one for a for a series episode number 4. Peace.